Today I would like to analyze General Mills, one of the largest food companies in the world and one of the worst performing stocks in the last 6 months. The stock price is down around 20%. So we can also see here this company owns a lot of famous products in America. So we're going to take a look at the financials to find out if it's a good buy right now. The first thing we can recognize is a market cap of 27.40 billion US dollar. This makes General Mills the 22nd largest food company in the world by the market cap. We also have a dividend yield of around 4.83%, which we can see here did grow in a very good rate in the last 10 years. Now we're going to take a look at the financials. The first thing we're looking for is revenue growth in the last 5 years. We want to invest in a growing business and not a declining business. So in 2021, the revenue was around 18.13 billion US dollar. This was a decent growth around 3%. In 2022, we saw the better growth around 5%. In 2023, around 5.8% growth. And then in 2024, we saw the decline around 1%. So overall, I think we had a decent revenue growth in the last 5 years, so it's a check here. The next thing we're looking for is the free cash flow growth in the last 5 years. The free cash flow is very important because it can be used to pay the dividend, to pay the stock buybacks, to invest in the business, and also to pay back the debt. So in 2021, the free cash flow was around 2.45 billion US dollar. This was a strong decline around 23% from 2020. In 2022, we saw the good growth around 12%, but then again, 2023, the decline around 24%. Then in 2024, we saw the comeback with a growth around 21%. So overall, in the last 5 years, we had a very inconsistent free cash flow growth, so it's not a check here. The next thing we're looking for is a free cash flow yield over 4%. So this can also tell us about the valuation of this company. The higher the free cash flow yield, the higher the indication for undervaluation. So we're going to take the free cash flow from 2024, 2.53 billion US dollar. We're going to divide it with the current market cap, 27.40 billion. And then we're going to get the free cash flow yield for 2024. This is around 9.23%. And that's a very good free cash flow yield actually. It's over the 4%, so it's a check here. And I think it's already an indication for undervaluation. We can also take a look at the free cash flow assumptions for the next years. We can see here in 2025 around 2.5 billion US dollar, in 2026 around 2.3 billion US dollar, and in 2027 around 2 billion US dollar. So this indicates a declining free cash flow. I'm not sure if these numbers are realistic, but let's assume for 2027 the lower free cash flow of around 2 billion US dollar. Then we're going to divide it with the current market cap, 27.40 billion. And then we're going to get a different free cash flow yield. So the number we're going to get would be around 7.29%. And that's still a very good free cash flow yield. It would be a check here. And again, this could be an indication for undervaluation. The next thing we're looking for is a debt to free cash flow ratio under 5. This means the company can repay the debt with a free cash flow in under 5 years. So this is a very important number because if a company has too much debt and cannot repay the debt, it can risk to go bankrupt. So first we're going to take a look at the long-term debt. So the long-term debt is around 11.3 billion US dollar. Then we're going to add the short-term debt as well. Current position of long-term debt, and here's the short-term debt as well. So it's around 1.62 billion US dollar. Then we're going to divide this with the current free cash flow, 2.53 billion. And then we're going to get the ratio that we're looking for. So that's around 5.10. And that's not really good. It means a little bit over 5 years we can repay the debt with the free cash flow. It's not a check here. We don't really like to see that. We can also take a look at the cash on hand, how much money this company has in the bank. And we can see here around 0.42 billion US dollar. And I think that's not very high as well. So overall, I think this company has a bad balance sheet. The next thing we're looking for is the enterprise valuation to free cash flow ratio under 25. So this can also tell us about the valuation of this company. The lower the number gets, the higher the indication for undervaluation. So we want to see a low number here. First, we're going to calculate the enterprise valuation. So this is the current market cap, 27.40 billion US dollar. We're going to add the debt as well. So the debt's around 12.92 billion US dollar. Then we're going to take minus the cash, 0.42 billion. And then we're going to get the enterprise valuation. So how much the whole company is worth. So the number we're going to get would be around 39.9 billion US dollar. So now we're going to divide this with the current free cash flow, 2.53 billion. And then we're going to get a ratio of around 15.77. And that's quite good actually. It's an indication for undervaluation. It's under the 25 and it's a check here. So we also can calculate this number for 2027 with the lower free cash flow assumptions of 2 billion US dollar. So then we're going to get a different number. So the number we're going to get would be around 19.95. And that's still quite good, I would say, and also a check here. So overall, I think this company does look undervalued right now. The next thing we're looking for is shares outstanding decrease. This means the company buys back their own shares. We like to see that, especially we think the company is undervalued. So we're going to take a look and we can see here, yes, this company did a lot of buybacks in the last 10 years. So in 2021, it was around 1%, and in 2024, it was very high of around 4%. So that's our huge stock buybacks. We like to see that, so as a check here. What I think is also important to mention that this company not has a good balance sheet. So I think they also need to take care of this. They should not get too much debt to finance the stock buybacks. Can General Mills stock be a good buy right now? This is one of the worst performing stocks in the last 6 months. The stock price is down around 20%. So let's start with a positive about this company. So I think we had a decent revenue growth in the last 5 years. The free cash flow yield is also very high of around 9.23%, which could be an indication for undervaluation. In 2027, with a lower free cash flow assumption, is still quite high of 7.29%. The enterprise valuation to free cash flow ratio of around 15.77 is also quite good, I would say. Again, this could be an indication for undervaluation. We want to see that number under 25. In 2027, with the lower free cash flow assumptions, the number is still okay, I would say, with 19.95. We also have shares buybacks. This is very good as well. It can help the stock price to increase. We also have a high dividend yield of around 4.83%, which also had a good dividend growth rate in the last 10 years. So what I don't like to see about this company is a bad free cash flow growth. It was very inconsistent. And also this company has a bad balance sheet. It means it has too much debt and not a good amount of cash on hand. So overall, I think it's an interesting company. The valuation can look okay, but personally, I wouldn't buy the stock right now because I think it also has a lot of risk with the high debt, and I think it's not a business I would invest in at the moment. If you found this video helpful, don't forget to like and comment and subscribe for more content.